We have your January 9th, 2025 market update, and here is what will be discussed. Number one, first and foremost in level of importance, you have your jobs report tomorrow that some are hailing as the most important jobs report of your entire life. That really has to do with how weak markets currently are and expectations for inflation that continue to ramp higher. Number two, we have some comments from Fed officials today that you should know before the jobs report. These are comments from Fed Harker, Fed Barkin, Fed Schmidt, and Fed Bowman. You also had what looks to be an unscheduled conference with Fed Collins. There's also some quotes from her in there as well. Also have this clip posted to CNBC with Tom Lee that says, as the title, Fundstrat's Tom Lee on why the rise in yields might be a false flag. I am convinced that this is indeed a false flag, that rates are rising really from expectations that nothing has actually changed in the economy. Think about that again. The rise in yields, the inflation expectations that have risen are all because of things that could happen that have not happened. Nothing has in fact happened in the last 4 weeks that changes the narrative on markets at all. I also want to share with you some of the alarming data that we got yesterday that again further kind of supports that point of not even just disinflation, but maybe even deflation that could be coming with a dramatic fall in credit card debt, what we have not seen since the Rona, and you had deflation then. And the fifth thing that we will cover here in this video is, broadly speaking, sentiment metrics. Are investors bullish? Are they bearish? Are they overpositioned? Are they underpositioned heading into tomorrow's data report? But first and foremost, before we get into all of this, hit the like button and subscribe to the channel if you like these market update videos. And now let's get started with this clip from Tom Lee, because I think it's very important that you hear this before tomorrow's jobs report.
10-year yield touching its highest level since April earlier today. But our next guest says the rise in yields could be a false flag. Let's bring in Fundstrat Head of Research and Fundstrat Capital CIO, Tom Lee. He's also a CNBC contributor. Tom, good to see you. Okay, so let's start there with the yield impact. What might people be reading wrong, you think?
Well, I wouldn't say markets are necessarily reading it wrong, but I would say, as uncomfortable as we are seeing yields at near one-year highs, I don't think that this is going to be the level we see a few months from now. And I think that's more important, because ultimately, if yields begin to fall because inflation pressures are easing, or if the job market is a bit softer than expected, it really puts the Fed back in focus. So I guess what I would just say is it's not comfortable to be here at where yields are. I don't think it really breaks markets, but I don't think yields are necessarily moving higher over the next few months. Well,
it's particularly uncomfortable, arguably, for small caps. Early last year, probably around this time, you made a bold call on how much small caps could rise. You've moderated from that since. But where do you see small caps going now? Why didn't the big pop that you projected for 24 pan out?
Yeah, small caps have been disappointing. I mean, unfortunately, I think there's been a rug pull on those names a few times. So I think investors are going to be very wary. But to us, I think the roadmap for 2025 is still one where the opportunity for stocks to have much better breadth widens, because not only do we have an incoming administration that is pro-business, and I think it is going to boost CEO confidence. It's pretty evident now, even seeing it in both ISM readings recently. But that's going to be a better environment for mergers. So to me, while small caps have been big laggards, actually for the last 10 years, this 10-year underperformance to the S&P is the worst in actually almost 100 years. So second only to 1998. And then from a valuation perspective, small caps are still much more attractively valued. The median PE is around 11 times, and that's almost 7.7 turns cheaper than the S&P. So it's been tough, John, to be overweight small caps, but I think they're going to work in 2025.
Okay. I do want to get your thoughts on some of the riskier assets or the riskier parts of the market that, or I'll use the word maybe potentially more speculative. Case in point, the quantum computing stocks, they had a huge move higher. Jensen Huang from NVIDIA comes out yesterday, makes comments saying that, some of the supercomputers are still, and the full, realization of supercomputers is still decades away, and you see all the stocks tumble. I know there's one that you like in your granny shots here. I believe it's IonQ. Just want to get your thoughts on what we've seen in some of these parts of the market and how to think about investing, if you should be investing in some of these more speculative or futuristic frontier tech-like companies.
I think investors do need to put a long-term lens on a lot of these important mega themes. I think quantum computing is in the earliest days. I don't think anyone can judge really whether it's 15 years away or 15 months. And I think people have made many mistakes over the past 20 years looking at things like social media and underestimating the adoption rates there, or internet, or even AI now. I mean, just think about 2 years ago, how many people were saying AI was going to actually take far longer than expected. That being said, I do think the environment for stocks hasn't been great for the last 3 weeks. I think it's really gotten people into a recency bias, thinking, look, we've neared a top, or that stocks are just awful now. I think we're getting close to the point where, you should be betting really and leaning heavily against that. I mean, even look at AI sentiment, it's almost back to negative. But Morgan, regarding quantum specifically, it is a pretty innovative technology. I think these are going to be high volatile names. And so until we get back to risk on, they are going to be tougher names to own, but I don't think that means you have to sit them out in 2025.
Now, next up, we will discuss what you need to know about the data coming out tomorrow morning. There is really two things to be concerned with in regards to tomorrow. It is a number that is too good that it's bad, and there is a number that is too bad that it's bad. Okay, a number that is too bad that it's bad is probably less than 100,000. Some people think it's like 50,000 or less. That would be bad. That would reignite growth concerns. That would be an issue. I actually think you want to see the number come in line with expectations or a little bit better than expected, because nothing has changed in our markets. Okay, people are expecting all of this inflation from tariffs. We don't know what tariffs are going to look like. We don't even know if tariffs are going to be inflationary. This has driven 10-year Treasury yields up dramatically since the election. Okay, I would say the rise in 10-year Treasury yields, it really is just the expectation of inflation from tariffs. What if we get 10% blanket tariffs that don't start a trade war? Then, what then? Probably not much inflation, if any. Inflation looks to be on a downward trajectory, even after last month's slightly hotter than expected number. Shelter inflation, which is still by far the biggest contributor to inflation, has fallen on a month-over-month basis for the last 2 months. I think we're getting to a point where markets are expecting way too much in terms of bad news for inflation, and there's actual data we will put to this in just a few minutes, versus the expectation of what we're actually going to get. Now, tomorrow's jobs report is part one. Part two is the CPI report next week. Now, if we come in with a really low number tomorrow for the jobs report, you may get an initial rally in markets, but it's not a good rally. Okay, because you always want to revert back to basic principles. What is the basic principles of markets? Okay, there's two things that move stocks. Number one is short term, and that is expectations. When expectations change and flip, that moves markets. Number two is long term, and that is earnings. Okay, so if stocks are going to do well in 2025, it probably has to do with earnings more than just expectations. Expectations are like what we're seeing now, where certain areas have gotten beaten down because of expectations. Okay, but it really has to do with the larger kind of labor market picture, okay, versus inflation. Meaning, if we get a low number tomorrow and inflation comes in low next week, that's not exactly great, right? Because sure, low inflation, but crap, the labor market's starting to fall out of bed. If we get a inline number for the jobs report tomorrow, or even slightly better than expected number for tomorrow, but next week's CPI report comes lower than expected, oh wait, we have a strong economy with lower inflation. That would be a very good backdrop for markets. And a lot of people have forgotten that you can actually see low inflation and a good economy and a good labor market. That is possible. So I think it's kind of a tricky situation coming tomorrow because we don't have the CPI report yet. So we need the CPI report, and that's going to tell us, whether tomorrow's report is, really good or really bad. But markets will react as if, I think inflation's going higher, right? That's how Wall Street's going to react. So that's why tomorrow's jobs report will be very important. Also, what Tom Lee said in this clip was very interesting, that Trump is pro-growth and pro-business. Well, wait. If we're all expecting Trump's going to cause this inflation and maybe even slowly enter into a stagflationary economy, that doesn't sound pro-growth or pro-business to me. In fact, you may not know this, but Trump actually invited China's president, Xi, to his inauguration on January 20th. That has never happened before. Okay, so do you really think tariffs are going to be this big problem that causes a trade war, that causes inflation to reaccelerate? I wouldn't invite, my trade war enemy to my inauguration if I was Trump, if that was my plan. Okay, that doesn't sound very pro-growth, pro-business of Trump. So for everyone that thinks Trump is going to be good for business, our expectations are as if he's not going to be good for business, which, let's be honest. Trump doesn't want to lose his donors a bunch of money in the markets because he messed up. He doesn't want to be the guy that took over from Joe Biden's term and ended the business cycle, that ended the growth story, that ended the bull market. I don't think that for a second. So I think we're really gearing up for a better outcome than what markets are currently expecting. And I think that's where the false flag comes from in 10-year treasury yields. I think 6 months from now, 4 months from now, we're going to be in a situation where the labor market's holding up. It's not great. It's holding up. And inflation is plummeting. That's where I think we're going to be 4 to 6 months from now, 3 to 6 months from now. That is a very bullish backdrop for markets because the Fed will be able to cut rates a lot. And hopefully by then you start to get some deregulation effects, higher M&A activity, and greater confidence out there to start putting money to work in markets. Now, we also have this situation where last month credit card debt actually fell almost $14 billion. You don't normally see this during a good economy, number one, but you don't see inflation that goes alongside falling credit card debt. In fact, really any time credit card debt has fallen since the 80s when credit cards became more popular has been during recessionary periods, right? So, a big drop like this, if it's a 1 month kind of thing, not a huge deal. But if next month is another decline, that becomes a kind of bigger thing. Okay, I want to call it a catalyst, but it becomes a little bit larger. Now, I do think, given the comparison here to the Rona, you actually had deflation then. I think this is a very good sign that you're not seeing upwards pressure on inflation. I've actually seen a lot of deals out there. I've seen a lot of good prices out there. I don't currently see inflation, again, like you've seen in 2021 to start the year, not even close to what you had to start 2021. And I know the inflation picture was a lot different then, blah, blah, blah. But judging off of this, I don't think you're going to get that inflation that everyone is expecting. In fact, another big catalyst coming tomorrow morning is not just the non-farm payrolls and the unemployment rate, which we'll look at that in just a moment, why some people think this is the most critical, non-farm payrolls report of your entire life. But you also get Michigan consumer sentiment. You're expecting headline numbers will increase about 1 point. 5-year inflation expectations will jump from 3% to 3.2%. That is pretty high expectations, okay? That's pretty bearish expectations. Consumer expectations are expected to go up from 73.3 to 74. Current conditions expected to rise from 75.1 to 78. And 1-year inflation expectations are expected to rise from 2.8% to 3%. You are expecting that consumers' expectations for inflation are really going to skyrocket in this report for January that comes out tomorrow morning. If we do not see that, perhaps inflation expectations stay the same or even fall, that's also going to be a huge positive catalyst to bring down 10-year Treasury yields. And with a slightly weaker than expected jobs report mixed with what I think will be lower than our expected 5-year, 1-year inflation expectations, you could see 10-year Treasury yields actually plummet tomorrow, which could give you a bit of a relief rally. But here's why some people think this is the most important jobs report of your entire life. Kurt over here says, number 1, why Friday's jobs report matters. This report could confirm or dispel fears that the Fed will pause rate cuts in 2025. The stakes are high. Here's how different outcomes might move the markets. Number 2, the context. After the December FOMC hinted at ending rate cuts in 2025, stronger than expected data created fears of a pause. This shift has pressured stocks, driving the SPX lower since December highs. Number 3, why the jobs report is crucial. Rate cuts drove the 2024 rally. If the Fed pauses, it creates a headwind for equities. While no rate cut is expected at January's meeting, this report could shape the Fed's tone on future policy. Number 4, the market scenarios. Let's break it down into 3 potential outcomes. Too hot, the Fed pause, fears rise. Just right, cuts in 2025 still likely. Too cold, growth fears emerge. That's kind of what I'm explaining. Too cold, growth scare. Too hot, no cuts. Okay, just right, cuts in 2025 still likely. I think that pretty well sums it up. Scenario number 1's too hot. 200,000 plus job ads, unemployment rate at 4.1%. Likely reaction, stocks drop over 1%. Treasury yields jump towards 5%, pressuring equities. And that's a bad kind of outcome. The too hot scenario continued. 10-year Treasury yields surge towards 5%. Dollar index rallies 1%, approaching 110. Gold drops sharply on a stronger dollar. And scenario 2 is just right. 50,000 to 200,000 job ads. 50,000. Okay, that's lower than what I would expect as just right. Unemployment rate 4.1 to 4.3%, wages below 4%. Likely reaction, a modest relief rally across all indexes, small caps and NASDAQ lead the gains. Yields drop 10 basis points, dollar weakens slightly. Just right continued, most sectors rise, led by tech, financials, and cyclicals. Defensive sectors post decent gains too. Number 3 is too cold. Negative 50 or below 50,000 job ads, unemployment above 4.3%. Initial rally on bad news equals rate cuts. Growth fears follow, pressuring cyclicals, materials, industrials, financials. Defensive sectors outperform and may even gain. The too cold continuing, 10-year Treasury yields drop sharply, nearing 4.5%. Dollar falls about 1%. Gold rallies hard on a weaker dollar. Cyclicals lag, while defensive may cushion broader market losses. Bottom line, the biggest risk is a too hot report pushing yields to 5% and intensifying the sell-off. The best case outcome, a Goldilocks number between 100 and 125,000 job ads. That calms Fed pause fears and sparks a relief rally. Brace for Friday, markets are on edge. Now also, take a listen to what the Fed said today. Now we did have a couple of Fed speakers today, Fed Harker, Fed Barkin, Fed Schmidt, and Fed Bowman. Let's take a look at some of those headliner quotes that came out. Fed Collins says the job market unlikely to be a driver of inflation right now. And she said, I am less worried about labor market fragility with the current outlook that calls for gradual, patient approach to rate cuts. She says, I supported the December Fed rate cut, but it was a close call. And she says housing factors still a major driver of inflation. Now, what I found interesting about that is the last 2 months, you've actually seen housing inflation coming down on a month-over-month basis. If that continues or picks up speed to the downside, then inflation could very easily surprise to the downside, and then all of these fears of inflation are unwarranted. Fed Collins says it's too early to say what impact the election will have on the economy. And she says, I now expect more inflation relative to the recent path. And the economy is on a gradual, uneven trajectory back to 2% inflation. She says the economy is in a good place overall with notable uncertainties, and the current outlook is in line with the Fed December forecast. Fed Harker says U.S. central bank still on rate cut path, future moves driven by data. Fed Harker says labor markets stabilized, are in a better place, and he says the underpinnings of the economy are strong amid high uncertainty. More of overall consumer spending is resting on higher incomes. As well as that, he says it's taking longer to get back to 2% inflation than expected. And Fed Harker says the Fed must remain data dependent and not act with haste. It'll be interesting to kind of see these comments versus the jobs report that comes out tomorrow, because Jerome Powell says Fed officials get important jobs numbers or inflation data a day or two before they are released to the public. So this sounds kind of like the jobs report's going to be a little on the hot side tomorrow, just kind of the tone of language they're taking. But then again, that's not, a certainty. Fed Harker says it's unclear what longer run path of Fed rate target is. And Fed Harker says, I don't see the Fed changing rate control toolkit anytime soon. Like, they're not going to adjust to a 3% inflation target anytime soon. Now, also, as Tom Lee mentioned, now we have new data coming out today. This is the AI Investor Sentiment Survey. Bullish investors is at 34.7%, neutral investors at 28.0%, and bearish investors at 37.4%. This is close to the 1-year bearish high, which was hit on November 27th at 38.6%. So you are about 1% off of your 1-year bearish high. Markets are extremely negative right now. You normally don't see this too often during bull markets. And when you do see it during bull markets, normally it's a very good time to be buying the dip. Normally that's when you want to start loading up on everything. Okay, so unless this is the start of a new bear market, then I think this is a good opportunity to be buying. Now, some areas are better than others. Cyclicals, industrials, value, healthcare, small caps, mid caps, software stocks, basically everything besides big tech, I think looks very attractive right now. Some areas a little bit more so than others, but very attractive as a group. Now, percent of stocks trading above the 50-day moving average at 34%, meaning 66% of stocks are currently in an active decline. Now, this is looking at the 50-day moving average. If you look at the 200-day moving average, about 49% of stocks are trading above their 200-day moving average. That is the lowest number you have seen in almost 18 months. I mean, if there's another better indicator to tell you when you should be buying than that, I do not know. Anytime you've bought when levels have been this bearish, you have made money in the entire history of our markets. Like, I mean, there's a 100% success rate with making money buying when markets are this negative. And the CNN Fear and Greed Index is at 32. You're in the bottom quartile of fear. And that kind of just speaks for itself as well. As long as we're still in a bull market, which last I checked, everyone thinks we're still in a bull market, then normally it's a good time to buy when markets are this fearful versus the optimal time to get out of markets. Now, I think with big tech, if you're still in a lot of big tech exposure, that is an area that I would trim. But pretty much everywhere else, I feel comfortable. Now, I don't like the quantum computing stocks that much. So maybe if you haven't trimmed some of those, trim some of those. Not financial advice. Do what you guys want to do. But yeah, there's a lot of this market that looks very attractive at current valuations. So let me know what you think about all of this information down below in the comment section. Ladies and gentlemen, that does it for your January 9th market update. Have a fantastic rest of your day, and I will see you in the next one.